Well, the Federal Reserve's summary minutes just came out. One thing to know about the minutes is that they can be massaged. This has to do with the end of January FOMC meeting, which is technically before we got the January CPI data, which we just got, the second week in February. So since the minutes are coming out in the third week in February, you think this would only reflect information known prior to that CPI release we got? So maybe this information isn't useful, right? But what's important to remember is that the minutes can be adjusted and doinked with, and they can remove certain phrases and add certain phrases to send a signal. After all, the Federal Reserve wants to clearly communicate. This is something Jerome Powell has regularly told us through the pandemic. He wants to clearly communicate when they're getting something right, what their path is, what their goals are, what their target is, as best as they can. And so I think this is a messaging tool much more than anything. And given that you've got a lot of folks talking about hikes again, it might be comforting to see this in the minutes. Regarding considerations relevant for future policy actions, members agreed, given their assessment of the policy rate being likely at its peak for the tightening cycle, to then adjust the phrasing of their last minute release, right? Or their last FOMC statement, rather. So that, to me, really started indicating this is going to be a cautious minutes read. And as we went through this, we got some caution in a way that we haven't seen before. First of all, we got more of an amplification on China and foreign markets. And we actually compared the last minutes to this set of minutes just to see where the Fed's head is. And this was interesting. In the last minutes, they suggested that China's, quote, economic growth remained modest. And in today's minutes, they said in China, a property sector slump and depressed consumer confidence continued to weigh on domestic demand. Keyword, demand. Why would keyword demand be so important? Well, because if we start looking at what they think when it comes to demand and foreign environments, take a look at this, or foreign economy. The upside risks to inflation were basically a copy and paste as usual. There could be supply chain shocks, or wages could basically stop slowing their wage growth, right? That's all the same as usual. But what was different, I like differences. What was different? This section right here, downside risks to inflation and economic activity noted by participants included geopolitical risks that could result in a material pullback in demand, possible negative spillovers from lower growth in foreign economies, that risk and the risk that financial conditions could remain restrictive for too long, or the possibility that weakening of household balance sheets could contribute to greater than expected deceleration. So you've got four issues there. And one of the ones they're really highlighting here is this idea that, well, what happens if foreign economies keep exporting deflation to us at the same time as household balance sheets weaken in America? You could see more rapid deflation. In fact, you could even have an upside, a surprise upside in foreign economies, but still inflation that surprises to the downside because of looser supply chains. This was such an interesting section because, of course, they had their usual section in here about, wage growth remains elevated and the risk of supply shocks. Of course, we know January core prices were surprisingly high. Barkin this morning tried to sort of brush those off as, it's January, so you get a big seasonal adjustment. Of course, that puts more weight on the next CPI report. But this idea about either yes, there being a risk of stalling inflation progress being a concern, not so much of a highlight on, inflation's going to skyrocket again. More of a concern is it might level off at a level that's still a little too high. But this extra emphasis on how much deflation we're getting from basically China and this, collapsing demand in China, the collapsing property market in China, weighing actually on U.S. inflation, with foreign deceleration leading to more deflation, or disinflation rather. And even if there's a foreign activities pickup, we could see supply chains move better to create more disinflation. Really interesting. So this whole section here, just to summarize that section, is the Fed's paying attention to what's not just happening in America, but what's happening around the globe for disinflationary pressures. Of course, those have to end up coming through in our data, but they do mention in here, hey, look, 6-month PCE is at 2%, or core PCE on the 6-month is below 2%. They're not going as far as declaring victory, but they're cautious here. And they're definitely not indicating in any of this verbiage that they're interested in going up. They are suggesting that they're not sure yet when they're going to cut. Is it going to be March? Probably not, because that would be imminent. I think they're going to signal in March with a summary of economic projections, and the first cut will then, TBD, I don't even think they've decided yet, be either May or June, and that's what markets are pricing in right now as well. Now, I'm going to have this full summary on ehack.com. I also did put on ehack.com that before the rate cut expectations were 94% for no rate cut in March, 65.7% no cut in May, and then a 73% chance of a cut in June. Those have now adjusted a teeny little bit. It's still a little too early to really get an adjustment here, but you did get a slight increase from 65.7 to 67.6% of no cut in May. But you're really removing this potential for another hike. We're basically at peak. You're not seeing a pricing in of higher rates, but you are seeing higher for longer, which they did advertise. So that's why it's more likely that we're going to see cuts in June or July than in May. Again, foreign headline inflation continued to fall. This is exporting deflation. We talked about how indicators of financial conditions did ease. However, the stock market had started rising, though that was really concentrated on larger mega cap tech companies, so wasn't necessarily fully broad-based. But then again, when you look at what we saw this morning, and we did an analysis on Wingstop in our Market Open live stream, we're all like, what is going on? How is Wingstop at like a 4 peg? The valuation is insane. The pricing for that stock is quite frankly stupid. But anyway, this was also interesting. Commercial real estate prices continue to decline, especially in multifamily. This was a very interesting highlight because I've seen this with HouseHack, my real estate startup. If you haven't learned about HouseHack yet, go to the HouseHack Homes YouTube channel. It's linked in the description below. We're probably doing a fundraise on Friday, so stay tuned for that. And we'll have another video with some more information answering some of your questions on that. But we're killing it. But one of the reasons we're killing it is because there's so many opportunities in multifamily right now. It's not looking good in multifamily. Not because we're seeing an imminent collapse, but because we're seeing defaults increase. 20x the defaults this January as what you had last January. Now that's wild. Default rates at 0.4% last January, now at 9%, which is 22x. And lates are at like 1/3, like somewhere around 29 to 30%. It's crazy. So the Fed is highlighting that commercial real estate, there are, there's pain there. I see these as opportunities. Leverage in financial sector was characterized as notable. I thought that was a really interesting note. They talked about consumers weakening and using buy now, pay later again, but they've talked about that in the past, so that wasn't so much of a change. I didn't see much of a change here. This is where you have, on a 6-month basis, PCE was near 2% on an annual rate, core PCE just below 2%, although they were concerned that maybe this was just because certain parts were going down and we didn't have that broad-based disinflation yet. And they did also note that job openings were at about that 1.4 level. This is something they want to see. How many job openings do you have compared to unemployed folks? We have various participants noted that housing services inflation was likely to fall further, and the disinflation in rents on new leases continue to pass through. There is a problem with this. I just want to explain the problem really quick. Just because new rents fall does not mean housing inflation goes down, because let's say you're renting a place for $2,000 and now the same place is available for $1,900. Are you really going to move for a $100 discount per month? Maybe, but it probably costs you $1,200, so your year of savings just to move, and there's a hassle and the stress or whatever. So there is a risk, and Barclays was highlighting this as well, that you don't actually get housing disinflation as quickly as you think, because even if rents come down, people aren't going to move to necessarily realize that right away. You do have many participants pointing to disinflationary pressures, coordinating to improvements in aggregate supply. Stock market didn't really love these minutes, although they might be declining because of NVIDIA earnings coming up, which of course we'll be covering live. And we also have the possibility that economic activity could surprise to the upside and inflation to the downside because of more favorable than expected supply-side developments. We touched on that already. We have high commercial real estate exposures at banks being a cause for concern, and also some talk about slowly thinking about slowing down the runoff of the balance sheet of the Federal Reserve, though we're probably not particularly close on that. This does feel cautious, and it is interesting that they're cautious. 10 of the individuals don't want to cut too fast or too soon. 2 of them are worried about us being too high for too long. So you're clearly weighted to let's not cut so quickly, as opposed to having more concern over that. However, the committee judged that inflation and labor goals were more in balance, which is something we've heard before, and that's pretty much your minute set. So bottom line there, cautiously optimistic, but not in a hurry. Right? It's like, hey, they're looking out to 2026 to make sure they don't get a recession in 24, 5, or 6. But they're not necessarily seeing the pressure to start cutting ASAP, so we're going to unprice March. And it's still a toss-up. Are we going to get May or June as a cut? Or maybe even July, frankly. So right now, the market is pricing in June. I will tell you, the market's unpriced a lot of cuts for December, though. We used to sit at we used to actually sit at nearly 100% that we would have 4 rate cuts by December. We're not at 4 rate cuts for December anymore. Right now, in fact, it just moved actually quite a bit even more. We're at 55% for December. So we're down to a coin toss now, 55%, a little bit down to a coin toss as to whether we have a 4 total rate cut by December, which the market was pricing in 7 rate cuts at one point. So we're not really seeing that at this point. Now, again, we'll be live in about an hour and a half for the NVIDIA earnings release. But here's a summary for us on what the Fed is thinking. No rush from the Federal Reserve. It's going to keep some pressure on some of the interest rate sensitives, probably. Though I will say, Enphase sort of recovered after these minutes. These minutes came out. Enphase is only down 1.5%. Honestly, if you're an Enphase investor, that's a gift for when Solar Edge is down 11% to only be down 1.5%. That's a gift. This is a very interest rate sensitive stock, and people know that. They invest in the stock because they believe they'll have a tailwind when interest rates come down. Yes, that comes later than expected. Fine, more pain for longer. But the fact that it's only down 1.5% after these minutes is a sign today's market movements are probably not interest rate risk. They're actually probably NVIDIA risks. This movement here on the Qs, my opinion, almost exclusively fear that the tech bubble has exploded or is about to explode, and you've got some downside risk ahead of you. So buckle up. Check out House Hack to learn more.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than House Hack, nor am I presently acting as a market maker.